A tale of two economies, AI boom amid housing and healthcare struggles. This week's earnings reports paint a vivid picture of a bifurcated economy, where the dazzling ascent of artificial intelligence, AI-related sectors, starkly contrasts with the struggles in housing, healthcare, and other traditional industries. With 89 companies reporting, the narrative of a K-shaped recovery, where certain sectors soar while others stagnate, becomes even more pronounced. Let's dive into the key themes, historical context, and global implications of these developments, while offering practical insights for investors navigating this complex landscape. AI, the unstoppable force. The AI boom continues to be the star of the show, with companies like GE Vernova, GEV, and Amphenol showcasing the transformative power of this technology. GEV, a spin-off from the historic General Electric conglomerate, is capitalizing on the insatiable demand for electricity driven by AI data centers. Its business of building gas turbines for utilities reported a staggering 55% year-over-year increase in backlog orders, reaching nearly $15 billion. While earnings missed estimates at $1.64 per share against an expected $1.86, the robust revenue growth of 12% signals long-term potential. Historically, GE's restructuring into focused entities mirrors the conglomerate breakups of the early 2000s, where specialization often unlocked shareholder value. Globally, the energy demands of AI are pushing utilities and infrastructure firms to innovate, positioning companies like GEV as critical players in the digital economy. Similarly, Amphenol, a once steady connector manufacturer, has been turbocharged by the data center explosion. Its third-quarter sales surged 53%, with earnings per share up 87% year-over-year. This is a stark departure from its pre-AI growth rate of around 20% annually, underscoring how technological paradigm shifts can redefine even the most mundane sectors. The global impact here is profound. Data centers are becoming the backbone of digital transformation across industries, from cloud computing to autonomous vehicles, driving demand for Amphenol's products worldwide. Housing, a market in distress. In stark contrast, the housing sector continues to languish under the weight of affordability challenges and high interest rates. PulteGroup, PY, the third-largest U.S. home builder by market cap, reported dismal numbers. Earnings per share dropped to $2.96 from $3.35 last year. Home closings fell 5%, and new orders declined 6%. NVR, another prominent builder, echoed this weakness with a 16% drop in new orders. These results are reminiscent of the post-2008 housing slump, though today's crisis stems less from over-leveraging and more from regulatory bottlenecks and cost pressures. Mortgage rates, though recently lower, remain a barrier for many buyers, and local zoning laws often stifle the development of affordable housing, a problem that demands federal intervention but lacks political will. Globally, housing affordability is a growing concern, particularly in developed markets where urban populations are expanding. For U.S. investors, this sector's struggles signal broader economic softness among middle and lower-income consumers, who are disproportionately affected by rate hikes and inflation. Healthcare and autos, mixed signals. The managed care space is another area of concern, with Molina Healthcare delivering a brutal earnings miss, reporting $1.84 per share against an expected $3.90, driven by soaring medical costs in health exchanges. The stock plummeted 20% on the news, reflecting a year-to-date decline of 47%. This mirrors broader challenges in the sector, as seen with United Healthcare's 2025 earnings guidance. Rising healthcare costs combined with reimbursement issues are squeezing margins across the board, a trend that has persisted since the Affordable Care Act's implementation over a decade ago. Globally, aging populations and increasing chronic disease prevalence will continue to strain healthcare systems, making cost control a critical issue. On a brighter note, General Motors (GM) defied expectations with strong pickup truck sales and raised 2025 guidance to $12 minus $13 billion in earnings before interest and taxes. Its stock surged 15%, a reminder of the cyclical resilience of traditional automakers even as Tesla, with a forward PE of 255 compared to GM's 6, captures the market's imagination with AI and robotaxi dreams. Tesla's own report showed a 37% drop in net income despite a revenue uptick, highlighting the disconnect between its valuation and current fundamentals. Conclusion: investment implications and near-term catalysts. For investors, the current market offers both opportunity and caution. AI-related stocks like GEV and Amphenol remain compelling for growth-focused portfolios, though their long lead times, in GEV's case, and high valuations, in tech broadly, warrant careful position sizing. Conversely, the housing sector's woes suggest avoiding homebuilders, like PulteGroup, until interest rates stabilize or regulatory reforms emerge. In healthcare, the managed care space looks risky, but selective exposure to innovative cost containment players could pay off. GM offers a value play for contrarian investors seeking exposure to traditional industries at low multiples. Near-term catalysts include the Federal Reserve's next rate decision, which could alleviate pressure on housing if cuts continue, and upcoming policy debates around healthcare costs and AI infrastructure investment. Globally, watch for energy policy shifts as AI's power demands grow, potentially benefiting firms like GEV. For now, a balanced approach, blending AI growth with defensive value plays, seems prudent in this tale of two economies. Stay vigilant and let the data guide your decisions.